Well, the third quarter wrapped up last week with a quieter slate of news and data flow, but it was nonetheless another week of downside for equities and another week of upside for the dollar as yields rose to new cycle highs across the Treasury curve. A busier week awaits the financial markets this week as the new month gets underway with a packed data docket, some antipodean central bank decisions, and of course, the latest US non-farm payrolls report due up on Friday. Plenty as always for us to discuss in the Trade-Off UK this week. Without further ado, let's get into the show. So a little bit more subdued in the financial markets last week, but hopefully volatility will come back with a bit of a vengeance this week as the new month and, of course, the final quarter of 2023 get underway. To help me run through everything that's going on and digest all of the latest developments, my co-host, as always, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, good afternoon to you. I'm sure you'll be pleased to know that my stint moonlighting on the Aussie version of this show is over for now, and I'm back to what we can call home.
Yeah, well, welcome back. It's a long way to go to do a show with those guys, but you equipped yourself very well, mate. You have to put up with those, to put up with Blake anyway, because he's a bit of a handful, isn't he?
Oh, he is, mate. He is far too energetic for 10:30, 11 o'clock at night as well. That's for sure. I mean,
he's just getting up at that point, yeah.
Well, yeah, quite. I was going to say that's definitely one where the time difference works in his favour, but nonetheless, plenty going on, isn't there?
Yeah, very much so. Every week we say it's a busy week. We've just come off the back of a load of central banks and month and quarter end, and here we are, big, massive slate of data, which we're going to talk about, and more stuff for us to trade and get our teeth stuck into.
Absolutely. Well, let's do just that and get our teeth stuck in to Topical Thunder. Right, I want to kick off with the jobs report. It is by far and away the most important data release of the week, I would argue, and I think most would probably agree. As always, the first Friday of the month bringing us our latest read on the health of the US labour market and, of course, the non-farm payrolls number that we all love to watch and predict. And I'm sure Ryan and his Forex Analytics crew will be running their usual sweepstake at some point throughout the week, so keep an eye out for that. Of course, this is all only possible after the US government managed to avoid a shutdown over the weekend, a bit of an about turn in the House to get a stopgap funding measure in place. So thankfully, no delay to the jobs number, no delay to the CPI report, and no delay to any of the other US data, which we were discussing on last week's show. In terms of Friday and our expectations for the report, it should once again show that the labour market remains pretty resilient. Consensus at the moment, according to Bloomberg, sees 165,000 jobs being added in the month of September. A little bit slower than the 187,000 that we saw in August. Of course, that is subject to revision, but it is still well above the 100-ish thousand that we need to keep up with population growth and in line roughly with the averages that we saw in the late cycle economy back in 2018 and 2019. So by no means disastrous, although I would just caveat that by saying that at the time of recording, we still have two ISM PMI prints and the next ADP number before the payrolls print. So those expectations could shift around a little bit. Unemployment seen ticking down to 3.7 from 3.8%. Participation unchanged at 62.8. That would be pretty healthy. A Goldilocks pace of average earnings expected at 0.3% on a month-on-month basis, I should say. All in all, that will paint a picture of a relatively resilient labour market. I think, of course, if we see a hotter than expected report, the market will start to upgrade its expectations of Fed policy shifts, currently pricing just a 1 in 3 chance that they go again in November. But Ryan, I'm keen to get your views on this because I think the bigger risks in terms of volatility are perhaps on a downside surprise, given how crowded the short rates, long dollar view is at the moment. If we do get a soft labour market number, if that does start to cause a little bit of concern about this US exceptionalism narrative, then perhaps we could start to see a bit of a decent sized unwind of some of those bets and positions that have been put on over the last few weeks.
Yeah, very much so. And we can almost, put the soft landing saying to this number as well, because, it wasn't so long ago we were printing, 3 320s, 360s, and it has gradually just come slowly down and down and down and down to lower numbers. Nothing major, a 22k difference over last month isn't going to shake any trees. But I think, the risk is that we see something falling off a cliff rather than a slow grind lower. I mean, if we spend the next 6 months going down to 100k, 50k, 80k, the market's going to be pretty well flagging that the jobs market is softening. So then hitting a negative number isn't going to be such a big shock. But if we do start hitting some big negative numbers, that's really going to get the market in a fluster, because then we're going to be trading, jobs are falling off a cliff now, so we need to start thinking about cuts even more. And then all those mid-2024 cuts are going to be Q2 2024 cuts, and, the game is afoot, as we say. But, the evidence so far suggests that we shouldn't really be looking for anything negative from these numbers. Jobless claims are actually trending lower over the last couple of months. We were up in the 240s, 250s. Now we're near the 200k mark. Even in the S&P PMIs that we got, it was gloomy amongst the components, prices, and that sort of thing. Jobs strongest since May. So, there's evidence to suggest that there is no problems impending with the jobs numbers, and if that's not a kiss of death, I don't know what is. But there is nothing really that suggests that anything should happen to these numbers. But that's why we love it. It's a big old lottery, and as much as we all look at the other evidence and say, shouldn't be a problem, we all know it can turn around with a big minus 300k out of nowhere, and then we're all running around with our hair on fire.
Well, you wouldn't be, but
I wouldn't know. But I'll put it on and then set it alight.
Yeah, potentially the commentator's curse that you've put on that one, Ryan. We'll revisit that next week, shall we? But I think you're absolutely right. There are a couple of moving parts. It's not just the pricing of do the Fed hike again this year, but also when do they deliver the first cut? I think markets currently price that from memory for around September next year. Obviously, if you start to see a string, easy for me to say, of poorer data releases, then you are going to see that cut pricing brought forward probably into H1. And you then start to question at what point do the Fed push back on that, because it would obviously be easing financial conditions, which is the opposite of what they want to be doing. But we could talk about that until the cows come home. We've got plenty of other data coming out this week that we should probably also discuss.
Yeah, as mentioned, a big data week, and the panic's been averted. We haven't just got to rely on the ADP numbers, thanks to that last minute injury time US funding deal. So we've got some other data to look at. So I've had a look and picked out some of the choice numbers that we need to look at. As mentioned, by the time you've seen this, you would have had the final global manufacturing PMIs and the one from the US ISM. Tuesday afternoon, we see the JOLTS numbers coming out for August. And we'll know whether firms are cutting back further on positions offered, which is, again, a further sign of a potentially easing labour market. Wednesday, it's the final services numbers from around the world, and again, that ISM number. And outside of the headline numbers in both the ISM manufacturing services, the employment and prices paid numbers are the key components that I'll be watching for those Fed expectations over whether they're done or not with hikes, and if it's a super soft number also, whether we're going to start seeing some cut expectations firming up somewhat. The services ISM is expected to fall back a little bit to 53.6 versus 54.5 previously. We get ADP 2, as you mentioned, that's expected in at 160k, so around the same mark as the NFP, that was at 177k last month. One thing we know of late about the ADP numbers, and we've discussed this on the show, is that a lot of those gains have been going into the leisure and hospitality sector. And that's usually the sector that suffers first in any real downturn. So if we do start to see some weakness there, could be some early flags being raised for that one. And we have to also remember that we are potentially moving into a strong holiday hiring season. Obviously got Thanksgiving and then going into Christmas. So it is a time when, not for this month, obviously, because these are going to be the prior month's numbers, but moving forward, we're going into that holiday period. So again, it could show that if there's strong jobs growth there, everything's tickety-boo. If there's not strong jobs growth there, that again suggests some problems if retailers thinking we're not going to get the business, we don't need the staff. So always something to look forward to on that front. Thursday's a bit light, but I tend to keep an eye on the Challenger Grey and Christmas layoffs report, just to see if there's any big surprises, any sectors, anyone laying off a lot of people that we haven't previously heard about, and what sectors that in. And then Friday, it's all about that big one, Denmark industrial production.
God, yeah, of course. We'll all be up early for that one. Don't even know what time it's out.
That's pretty fishing you from last week. I thought I'd drop that in at the end.
You got me. You didn't even put that in your notes. Well done. Yeah, it is a big week. I mean, out of all of that, I think the ADP number is just a bit of a joke, to be honest with you, at this point. It could literally come out anywhere, and the chances are, 90% of the time it has absolutely no bearing in terms of direction or absolute number on what the payrolls number might look like on Friday afternoon. So just take that one with a huge pinch of salt. If we do see a sizable market reaction to that one way or another, then it could be one that may fade relatively quickly, given that it's data that is unreliable at best, let's put it that way. The JOLTS number is going to be interesting. I think the key things to watch there, as always, are, as you rightly said, the overall openings number, of course, but also the quits rate and the ratio between the number of unemployed people per job opening, because both of those have been coming down quite substantially of late, and they're metrics that the Fed do watch pretty closely for signs of the labour market loosening up. So they are worth watching, even though the data is a little bit stale and references August. And then, as you rightly said, the ISM services gauge, by far and away, I would say one of the most important US metrics, given everyone is on this bandwagon around a soft landing. That is worth watching very, very closely indeed, particularly as it comes on PMI day, for want of a better word. We get the data for Europe, the UK, and most of Asia as well. So it gives us a nice way of looking at that US outperformance theme. But, as you rightly say, it all pales into insignificance compared to those Danish production figures.
Yeah, exactly. And it's also double bubble Canadian data as well. So we get their jobs report, which is going to be important for you loony traders, which I hope you factored that in on your slide that is coming a bit later.
I did. I was also going to say who actually cares about the Canadian jobs number, but someone somewhere out there will. Maybe the Bank of Canada governor and no one else.
Yeah, very much. Well, I care about it because I'll be looking to trade it as well. But well, I'll leave it for you this week.
There we go. Thank you very much. How kind of you. Speaking of leaving topics for me, this is normally one that you bring up, but I've managed to pinch it from you this week, and that is, of course, China. The reason why I want to bring China up is, well, we had the latest PMI figures out of China over the weekend, and they just kind of reinforced a bit of a theme that seems to have been going on of late, where data has not been coming in brilliantly, but it started to come in a little bit better than expected, and importantly, starting to surprise to the upside rather than to the downside, which we had seen for so long. Now, of course, the usual caveats have got to apply here, those being that the data is probably made up and very, very unreliable indeed. But nonetheless, we have seen I can just see you chuckling there. We have seen the official state PMIs all come back above 50. The composite PMI in September printed a 3-month high as well, which is a promising sign. And then if you look at some of the other data that we've had over the last month or so, industrial profits, retail sales, industrial production, all beating expectations. We had that required reserve ratio cut come through as well, although, of course, the headlines around stimulus have been a little bit lacking of late. And it's just got me thinking that, are we now at, or perhaps even past, the point of peak pessimism when it comes to the Chinese economy? Now, of course, the whole of China is shut this week for Golden Week and the bunch of holidays that they have associated with that. So that may provide a little bit of a boost from the consumer side, from the spending side of things. But next week is going to be a really big one for China. We've got not only CPI and PPI, the latest inflation reads, but we also get the latest trade data, imports and exports. And both of those figures were pretty disastrous when we got those for August. So we'll be looking for those to rebound if we are to see those tentative signs of a turnaround continuing. And I think when you just apply this more broadly, obviously you've got Chinese assets from a technical level. We haven't got it in the charts this week, but the Chinese A50 index, the futures, have a huge support level at 12,225, which is a whisker away from where we are at the moment. So that could perhaps be a level to get long. And of course, in the G10FX space, you've got both the Aussie and the Kiwi, which could get a bit of a lift if we are indeed past this peak pessimism point. So I'm not saying all is solved. I'm not saying that China is going gangbusters once again, but the skies do seem to be clearing a little bit. Let's put it that way.
Yeah, I think that so apart from the markets that view, the skies have stopped falling in. And I think passing peak pessimism is the right saying for that, the right description for that, because the market had got heavily pessimistic on China. The Chinese themselves weren't, as they tend not to be. You know, they've got things under control. They've hit it with rate cuts, small rate cuts, tinkering around the edges, fiscal support, direct into the economy via, electric car subsidies and that sort of thing. So they've been beavering away, doing what they need to do in the background. The market always wants more. Obviously, it wanted more rate cuts, it wanted more easing, and more this, more that. And it's been good to trade through it, as I'm going to explain in my latest slot. But yeah, I think it's definitely not out the woods. They're definitely out the woods, but the property thing has been dragging on for 2 years now, and still, it's not collapsing the whole world. They've got it contained. Yeah, there's going to be blow-ups, but they will have it contained, and that's not going to change. The question now is this just a bit of a flatlining, like hitting the bottom and rolling on the floor, or are they really going to sustain a decent bounce? I suspect not. I think we're probably going to see a limited bounce. As you said, the mainland PMI is coming in okay. The private ones, the Cajun ones, not looking as hot as that. Little couple of dips in those, still above the expansion line, but getting pretty close. So it's definitely not out the woods yet. But as far as markets are concerned, and when we're looking to trade things like this, if something stopped going down, then usually the only other way it can go is up. So we have to watch for that, and maybe how far it does go up.
Indeed. I'm sure that's something that both of us will be watching very, very closely indeed. Now, in terms of the Japanese yen, I've got two things to say here. Firstly, bravo on your excellent pun work with the subtitle. And secondly, having seen the length of your notes here, I'm just off to make a cup of coffee and I'll be back in about
Yep, you do that. One sugar for me, please, mate, and I'll have a couple of biscuits as well. We're going to be talking about intervention, because I think we are getting close now. The market's put a big, fat intervention level target at 150. That was previously 145, and look what happened there, absolutely nothing. So a lot of the market is looking at 150 again. The intervention talk has been rife, so it's worth just going over the conditions that are possible for intervention. Firstly, there's a jawboning. This comes in several stages and threat levels. At the moment, we're probably 1 or 2 steps away from being fully in intervention mode. The current language is watching with a high sense of urgency while maintaining FX must move in line with the fundamentals. The next step for these guys is mentioning either or both of speculation and volatility. For volatility, we already know that if we're seeing that in yen pairs, and particularly dollar yen, we'll be seeing the price move 200-300 pips in a session in a day. We're not there yet. We're not seeing that sort of volatility. Speculation comes in when officials decide that moves really aren't reflecting the fundamentals, that perhaps some in the market are pushing the buttons. But things are different this time in terms of intervention. So what's different? Well, as mentioned, we haven't got the volatility. Secondly, the moves are largely fundamental, but mostly on the dollar side, because we've obviously seen a lot of dollar strength coming into markets. Now, I think officials may be more worried about the level of the yen this time around. There are several metrics to look at for judging yen weakness or strength. There's the trade-weighted indexes.
Yen strength, that's a lot.
Yeah, it happens. Trust me, it happens. You remember they were intervening on the other side when it was down in the 70s, 75s.
That is very true. That is very true.
there is a lot of time and water under the bridge between them, but they are happy to go both ways. So they do look at these trade weighted indices just to get an overall view of strength or weakness. In this case, weakness. They can look at the REAs, which is the real effective exchange rates, and they can look at the NEAs, which is the nominal effective exchange rates. And the one that the Bank of Japan looks at is the NEA, and they actually publish this daily on their website. It's currently, down in the low 81s, I think around 81.22, and that's well below the 81.72 we saw when we had the last interventions late last year, September and October. All these indices are showing that the yen is at worse levels than it was back then. So this might cause officials to change tack on that intervention call. It may not be a volatility thing anymore. It may not even be a fundamental thing anymore. It may just be the level they potentially look to intervene at. We've also had a lot of talk from officials that they're in constant contact with their international partners over FX matters. And that really raises the risk that an intervention this time may be aided by Japan asking those partners to intervene on their behalf via their own currencies. So, for example, the ECB intervening in euro yen. Now, that would largely increase the effect of intervention, but it also brings danger to other pairs, because if foreign CBs are selling their own currency, they'll be quick to diversify that into other pairs and other currencies, covering those sales through those other currencies. So like the ECB, they may sell euro yen, but they likely diversify that by buying something like euro dollar. So while you would see euro yen obviously dipping and significantly on intervention, you might not get euro dollar following it like it did last time, and in case might go the other way. So if that diversification happens, if those other authorities intervene as well, don't think for certain that all euro pairs will move the same way. There's going to be differences. That's going to create a bit of trouble. But I definitely think that the risk this time around is more the level of the yen rather than the volatility.
That's a very interesting one, because I think the risk is almost entirely the other way around, particularly if they want to get other, and I don't think they will, but if they did want to get other allies, for want of a better word, to try and help them out, I really can't see the ECB going, yeah, we'll happily help you out when the euro is also falling through the floor. I think it is a volatility thing, purely because to try and justify these sort of interventions from a political standpoint, it can't simply be a case of our currency is too weak, we would like to prop it up. Well, if you want to prop it up, stop the BOJ printing a ridiculous amount of money, stop the BOJ doing yield curve control, get the BOJ to finally raise rates out of negative territory. That's what's going to prop the yen up properly, rather than the Ministry of Finance burning through their currency reserves to try and do it. So I do think if they do go down that route, it is going to be a market function, speculation, volatility type message that they give out. But I agree with your original point about 3 hours ago, that we do need to talk very, very closely. And as soon as you hear the words speculation and volatility from the cabinet secretary or sorry, I'm just imagining a sort of Japanese Sir Humphrey there. That's a mental image. The cabinet secretary or the finance minister or anyone like that, when you hear those words, that's the time to get worried if you're short yen, I think.
Yeah, I mean, the playbook should be the same. The only thing, as I say, these little comments, because I listen to this stuff all day long. We've had Suzuki with the same lines twice today, and Matsuno, and it's the same old lines. But you notice when there's different language going in, and there has been an uptick in mentioning that they are in constant contact with their international colleagues, which they didn't mention last time we had the intervention, or not to this level. So the fact that they also mention in the trade weighted index, it just means they're potentially looking at other things. It doesn't mean it's going to be a trigger, but it's perhaps more something that's weighing on their thinking rather than just purely speculation and volatility. But as you say, if we get both of those along as well, then yeah, we're one step for intervention. And if you're short yen pairs, you got to be careful.
Absolutely. I mean, at the end of the day, no one really knows what the Ministry of Finance are watching. I'm not sure many people inside the MOF know what they're watching. And knowing our luck of late, they'll probably have intervened and dollar yen will be down by 145 by the time someone watches this show. So we'll see what happens, I guess.
Yeah, very much so.
Right. With that little whistle-stop tour of the financial markets done, let's get into some charts. Right, what am I starting with this week? Gold, as you can see, we're well prepared on this programme as ever. Right, gold. Well, it's woken up a little bit, which is nice to see at long last. It's only taken, 12 straight weeks of dollar gains and almost daily headlines that, daily headlines that 10 and 30-year nominal and real yields are hitting their highest levels since the financial crisis for gold to finally break the way that the textbooks tell us it should have done. Last week was absolutely dismal for the yellow metal, down well over 4% on the week. We've now had 6 straight days of losses for gold, which is its worst run of the year. And on a technical level, we've broken below $1,900 an ounce, which was obviously psychological support, and then scythed through the prior year-to-date lows, which came in around 1885. There is pretty little here in way of further support until the February and March lows, which come in around 1810, and you certainly won't find me wanting to catch a falling knife in this environment. I think I'd only become interested in buying a dip in gold if we see a sustained turn in the dollar, which is likely to require a sustained turn and rally in treasuries. And as we were discussing earlier, both of those feel a fair way off for now. So I think riding this down towards the year-to-date lows in February and March is probably what I'd be looking to do in terms of gold.
Yeah, well, this definitely woke up, got out of bed on the window side and actually fell out of it. So, yeah, I mean, I tried catching a knife. There was a fib down at 1895, and then we had that prior support 1885. I tried catching knives into that, and I lost a couple of fingers on that one. But it has been one-way traffic, and that's it's been really strange because, from a fundamental point of view, it shouldn't really be falling out. So that I think there is a bit of asset switching around going on here. Obviously we're seeing bond yields rallying. There is a theme to say people are maybe getting into bonds, locking in those high yields, because you might not get the yield in the metals and things like that. So, there's a big investor switcheroo going on, as we like. But technically, I know there's a lot of eyeballs down at the low 1800s. If you're going to try and catch a knife, that's where you might want to be doing it. But if the trend is still pretty strong, you don't want to be risking a lot. You don't want to be giving it too big a stop, because if you are wrong like I was, then just lose a couple of fingernails rather than your whole hand.
Absolutely. The other one is just to note, this is a move that we're seeing across precious metals. We haven't got any other charts here, but silver hit a 6-month low earlier on today on Monday, and it's not only isolated to gold, and we're seeing that downside momentum start to accelerate a little bit. In any case, Ryan, let's go down under. Yeah,
let's get down under. I'm going to look at Aussie Kiwi because we've both got both the RBA and RBNZ coming up. And this one's looking very interesting with both central banks announcing one after the other. And by the time you see this, we'll know what the RBA has done. It's likely they've done nothing, kept their statement pretty much the same. That's been saying some further tightening of monetary policy may be required, but will depend on the data. Inflation is a big part of that data, and like elsewhere, it has ticked up a bit. We also have Michelle Bullock chairing her first meeting as RBA head. So there's a bit of a risk there. The RBNZ, that's meeting the early hours of Wednesday morning. The Kiwi economy is doing okay. It's in soft landing mode, pretty similar to the US. But I've had a look at it, and there are some bubbling wage pressures underneath. Inflation there is printed quarterly, so we won't know any up-to-date information on that front. Good chance it might follow the others in just remaining sticky, maybe edging up a bit. Now, these folks are in full pause. There's no possible rate hikes on the horizon. They are in pause, restrictive levels, and are going to remain so for some time. So they have no further guidance towards further hikes. So for me, I think there's a small risk that the RBA is a touch more hawkish, and a potentially bigger risk for the RBNZ. So for trading Aussie Kiwi, I'm looking at possibly shorting an RBA induced rally in Aussie Kiwi back to the mystical 108 magnet. As you can see on the chart there, we keep coming back there. Then maybe run that short over the RBNZ, because if they are hawkish as well, then we're likely to see that pair dipping once again. We have a trend line not too far from here, around about 106.80-ish. That would be nothing I would consider right now because we're so close to the price there while we've got these meetings. But if plan happens and I get into a short, that's the sort of area I'll be looking to potentially take some profit if it goes to plan. Otherwise, I'll be more watchful for a potential dip buying opportunity down into maybe the low 105.50s, 105s, just for more of a range play if we get through these central banks and there's nothing major, but we continue to trend lower.
Yeah, it's going to be an interesting one. I mean, if you're trading this purely based on performance in the Rugby World Cup, you would just be limit short this pair. The Aussies have had an absolute shocker, and don't you really hate to see that? More seriously, I think this is a case of what the RBA and the RBNZ do in November. No one, really prices any chance of anything happening this week, but both the market sees around a 1 in 2 chance that they hike again at their respective November meetings. So I do think it's all around the guidance for those decisions. Is one more hawkish than the other? If they are, then that's obviously the side of the pair that you want to be riding from the long side. But personally, I'd be looking to wait for the dust to settle a little bit on this week's central bank decisions, get those statements, read them through, and then take a more medium-term view into those November policy decisions, and perhaps exploit a repricing if we were to get it of the rates curves subsequent to that.
Yeah, wise advice, mate. Wise advice.
Thank you very much, mate. Right, let's have a look at the euro. Not quite dead and buried just yet. I mean, last week was an 11th straight weekly loss for the common currency. I think that is still the longest run on record, or extending the longest run on record. But I'm sure someone somewhere in the comments section can correct me if that is incorrect. What is a little bit more interesting, though, is both Thursday and Friday, we failed to get a closing break below that 105 handle, and twice we tested the year-to-date lows at 104.84, and twice we managed to hold on to them. So we have rebounded just a touch, but the rebound really does seem to lack conviction. I mean, we haven't even managed to make our way back to the 106 handle yet, let alone resistance above that. Now, I brought up the euro as my play of the day, actually, in the Aussie version of this show with Blake Morrow last week, and I was still short the euro, but flagged that there is a risk we could see some consolidation and perhaps a little bit of rebound back towards that 106.50 level. And that really remains my view, although the longer time goes on and the rather lackluster nature of the rebound suggests that we might actually not even get there. So I am still bearish on the euro. I still view it as a question of when rather than if this 105 figure gives way. And if it does indeed give way on a closing basis, then we should and could see those mid 103s in relatively short order, I'd expect.
Yeah, very well summarised, mate. And I posted a chart last week when I think we were at 105.60 something, a completely blank chart, but with a line in at that 105, because it really is a huge historical level. One of those levels, as you can see there, where if you haven't been there for a while and you come back and hit it, if there's nothing strong enough to send it through, then you're going to get a good reaction. And I was fortunate. I started buying it 105.20s down to 104.90. There was always a risk that it might just tip through, trigger a few stops, and then bounce, which is likely what it did down to those lows. But yeah, it was a solid enough bounce up to 106. I think we topped out around about 106.10, 11, something like that, which was actually a bit of a break point, a bit of a support point on the way down, but it didn't last long up there at 106, as you say. We back down. I don't like it when we test the level, bounce, and then come back really quickly. So I think there is a lot of danger potentially for this second test of the 105 area, if we get one, as we're sitting here now and keeping half an eye on it. We're at 105.24, been down to 21. So it's going to be touch and go, this level. But I completely agree. If we do break it, then it's potentially going to have some legs all the way back down.
Indeed, selling rallies certainly remains my preferred strategy here. Right, a final chart. Why don't we have a look at... we're looking at China again.
Yeah, well, I thought I'd keep it, in the theme of things. As you've decided to move into China, I thought I'll match that with talking about the currency. And this one, again, it's a bit of book talking, because I've been on the short side of this one up to the recent highs. And I was actually short before then, before we got to those highs, and got stopped out on that move. But I wasn't happy, so I jumped back in again. Now, we've been ranging between 732 and 728 recently, but as you mentioned, the data has maybe turned a bit more positive, and at least the bad news and easy measures aren't getting the negative reaction in the one that they were before. The latest run up over 732 came on last week's dollar buying for those flows a month quarter end, rather than on the fundamentals or anything more negative happening in China. That for me remains the main risk for this pair, the dollar side of things. But if the dollar stops gaining as it has been, the downside, if it opens up through sort of 728, more so 725, we could get a push down to the 720s. So I'm still confident to stay on the short side with this one, but my marker for that is this 732 level and remaining below that. And that's a level fresh shorts could maybe consider to lean on if you want to get into shorts like me. But like me, you'll want to be quick in taking profit if you get down to that 728, 29 region. It's just worth jobbing the range just to try and put a bit in the bank, put some regular money in the bank just to protect against a potential rally. But yeah, if the dollar continues its march and picks up, then maybe we are in for another move to the high sides. But failing that, the Chinese are going to keep intervening there. So it could keep a bit of a lid on it.
Indeed, very well summarised, mate. I think I covered everything I had to say on China a moment ago. But all I'd add here is, the range is pretty well defined. So don't get greedy, as you rightly say. If we do get to one extreme of that range or the other, then there's absolutely no harm or shame in banking a proportion of that trade, or even the entire trade, and then waiting for the market to come back to your preferred levels. It's certainly not one that I would be looking to chase anytime soon.
Yeah, very much. And you never go broke taking profit, as they say.
Absolutely. What a brilliant saying that is. Right, let's have a look at our plays of the day. Two FX plays for you this week. Starting off with dollar CAD from myself. We did have a brief rally in the loonie a couple of weeks ago below that 135 handle. But what that's actually helped to do is mark out some pretty strong support at the 134 figure, and this bunch of moving averages that come in the mid 134s. That has proved very, very strong support indeed, particularly the 50-day moving average, which I'm sure you can just about make out in bright pink there, which is starting to really help to underpin the rally that we have seen over the last week or so. Despite oil continuing to move to the upside and WTI and Brent both rallying strongly again last week, the march higher in the dollar is just too strong a force to be reckoned with here for the Canadian dollar, and for pretty much everything in G10FX, if you just look across the G10 board. So I am looking for the upside to continue here in dollar CAD. Of course, as Ryan alluded to earlier, we do have those Canadian jobs figures out on Friday, so that is a risk if we do get hotter than expected data there. But I am looking for this to move back towards the 137 handle. Happy to ride on the long side of this one. If we do get back under that 50-day moving average, then obviously this view is somewhat invalidated or entirely invalidated. But yeah, 137 is my initial target to the upside. Take a bit of a chunk off at the figure, and then maybe let the balance run towards the March highs, which come in around the mid 138s. 138.35 was the high that I think we saw in March. Ryan, what are you looking at in dollar Hong Kong?
Yeah, I'm going back to an old play on this one. Dollar Hong Kong. Are we going to hit the top of this band? For those that don't know, the HKMA, the Hong Kong Monetary Authority, they run a band in their currency, 785 to 775, and we're just coming up to the top end now, and I'm looking for shorts into this level. It's a trade I've played before, but sometimes you do have to wait it out after getting in. The positive with that, though, is that if you have to sit in it for a while, there's no big carry costs to pay for being short the dollar, as the HKMA runs their interest rates pretty much in line with what the Fed does. So you're not, like dollar yen, you're going to pay an awful lot to sit in shorts. This one, not so much. So I'll be looking to enter close to that 785, maybe above 784.50, scale it in a bit. But I'll be looking to offload some in any decent dips into the 783s while keeping a core short position, and just sort of add back on the rallies and get out of some on the dips and build a larger position. But it's been a trade that's, if you can have the patience for it, can be pretty profitable.
Absolutely. Yes, indeed. It's certainly better to do that than be one of these morons who rants on Twitter that, the peg's going to break tomorrow. It really isn't, guys. It really isn't.
I think Carl Bass, is it Carl Bass? He likes to have a go at the peg whenever at one end or the other, but he hasn't done it thus far.
Exactly that. Right. Well, that does bring us to the end of another show. Thank you very much for watching. Thank you, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me, and to our producer, Kyriakos, for bringing this together as brilliantly as he always does. All three of us will be back again with another show this time next week. If you enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or if there's anything you'd like us to discuss next week, and we will see you again then. Thanks very much for watching. Goodbye for now.